Welcome back to another episode. I'm your host, Ryan Richards, residential loan officer and real estate investor based out of Massachusetts and Rhode Island. So today I'm bringing a solo episode talking about what realtors need to know and understand about mortgages in order to best position their clients who are getting financing. And not necessarily the boring mortgage jargon and all of the guidelines that we have to deal with and reference, but more specifically from a strategic standpoint. What do you need to understand about how mortgages work, how to interpret pre-approvals, and the impacts that different types of financing can have, whether you're a buying agent or a selling agent? So if topics like this interest you, stay tuned, we'll dive through it all. So I'm excited to dive into this topic because when I talk with different real estate agents, a lot of times, naturally, they have different understandings and perceptions of mortgages and financing. And inevitably, what ends up happening is the understanding that they have at the beginning, if it's not impacted or changed, it becomes kind of set in stone. And I think what's really important to know is that mortgages are always changing and evolving. So you hear the classic example of a real estate agent who's been in the business for a long time feeling as though things are done a certain way, or certain mortgage programs and products mean certain things. And that's true, but a lot of those things can change over time. So here's a couple of things that you can think about if you're a real estate agent to make sure you have a great grasp on financing and some of the strategies and impacts that different types and different structures can have. So first and foremost, of course, if you're a real estate agent, you're in the real estate industry, you've heard this one before. But understanding the differences between a pre-qualification, a pre-approval, and a pre-underwritten borrower. And a lot of different companies will use different words for that. Pre-commitment letter, underwriting approval, home buyer certificate, but that's another step of due diligence that we'll talk about. What's really important to know is that number one, not all pre-approvals, pre-qualifications are created equally. The letter that you get is only as good as the due diligence done by the loan officer behind it. So that's where the different types of pre-approval letters or pre-qualification letters comes into play. So you have really three main types of qualification for someone looking for financing before they have a house. You have your pre-qualification, your pre-approval, and your underwriting approval. Number one, starting with the least accurate and least thorough, you have the pre-qualification. A pre-qualification is more or less a ballpark on what someone might qualify for. Now, loan officers, to do that, we don't have to have all of the documentation in hand. We can have a verbal conversation with someone about, hey, how much do you have in your bank account? How much money do you make? I don't necessarily need to see pay stubs or see bank statements to issue a pre-qualification, which I almost never issue a pre-qualification only because it doesn't really carry a lot of weight. And I want to be able to say when I issue a pre-approval letter or tell someone they can get financing that they absolutely can. So I want to make sure I verify all of the documents and confirm all of those numbers, which would put us into the next category, which is a pre-approval. So pre-approvals not only review the numbers, but they verify. So that's great you have $60,000 in your bank account. Show me the statement. That's great that you make $140,000 in a salary. Show me the pay stubs and the W-2s or tax returns and so on and so forth. So we actually verify those numbers. And sometimes there's differences that come up. Not necessarily in that people tell us the wrong numbers, but we look at things differently through our lens based on how we qualify someone, different than what they might be receiving in income. You know, if you have a self-employed borrower who makes, say, $100,000 this year, that's great, but we're not looking at 2025 numbers. We're looking at 2024 on the tax returns and probably 2023. So just differences in how we look at things. But it's really important to take that extra step to verify. And what the pre-approval also does that's different than the pre-qualification is, one, we'll pull a firm credit report on typically all three bureaus, and we'll also get an automated approval through the underwriting software, which 90% of loans done today have to take that additional step in the end to get financing. It has to get approved through the automated software. But if we don't have the right numbers and data to input to the software, it could give an incorrect reading. And sometimes that's really important. On paper, I might have someone who qualifies very well, strong credit score, good down payment, reasonable debt to income ratio, but the software won't grant the approval because the software takes a more holistic look. How much availability do you have on your credit cards? Have they missed payments recently? What do they have in excess reserves in the bank? How much are they putting down relative to the value? More or less, is this borrower a good credit risk? Will they pay back this loan? So sometimes they fit all the written guidelines as a client or borrower, but they can't get the software to support an approval. And that does happen. So if you don't do the pre-approval up front, you won't know the result of that software until you get into the process. The next step, which is an even further level of due diligence, which I try to get all of my clients to do, is an upfront conditional underwriting approval, which essentially takes it one step further. So they take everything I've compiled for the pre-approval, and we actually have my physical underwriter review the file, basically double check the numbers, double check the paperwork, and issue a conditional approval from the underwriter, which obviously carries a lot more weight in terms of the confidence level in the financing, because at the end of the day, the underwriter is the only one who can actually approve the loan. Loan officers can do the pre-approval, basically the before you're approved type of estimate, but the underwriter is the only one who can actually approve the loan. So having that second set of eyes from the decision maker is very important, and it carries a lot of weight to not only the client, knowing they're that much more likely to get the financing, but it also carries weight when presenting it to agents like potentially yourselves if you're listening. So reading the language in the pre-approval letter gives you insight as to what types of due diligence that loan officer has done. And don't just rely on the title of the letter. Different institutions call these types of letters different things. So when you're reviewing offers or reviewing a pre-approval for your buyer client from their lender, actually read through the wording to see what types of words they use. Did they use verify, or did they use provided? These types of words give you insight onto what types of information these loan officers looked at. Does the pre-approval letter reference an automated underwriting decision? Does it reference that the actual underwriter looked at things? Did the actual underwriter sign off on the pre-approval? These types of information gives you a lot of insight. So actually read the letter, look through what information the loan officer collected and how far they took that in their due diligence process, because that's very relevant for this next point. The second thing that you want to think about or know as you start to review pre-approval letters and financing is that more down payment doesn't mean the borrower is more qualified. And I think that's a huge misconception in the industry. If you have two pre-approval letters, and one, they're both approved for a $500,000 price, one has a 5% down payment, and one has a 50% down payment, logic would say that client who's putting $250,000 down is more qualified than the buyer who's putting $5,000. But that's not always the case. Again, it comes down to the level of due diligence that the loan officer who gave the pre-approval, or underwriter who gave the pre-approval, went through to validate their qualification. Because I've had clients who are putting 50% down because they have to. They only qualify for a $250,000 loan. So it's still about how much financing are you getting? How confident are you that the right steps were done to validate their qualification? Really, the down payment doesn't have anything to do with their qualification. Of course, larger down payments can have better implications as far as appraisals and appraisal flexibility. But in terms of qualification, it comes down to the lender, the loan officer, and the due diligence. So that's an important thing to consider. If you're looking at two pre-approvals, I would still, regardless of the down payment, look into the letter to see what types of things were verified. And don't just assume that because someone's putting more money down that they're more qualified for the mortgage. Because we're approving you for the mortgage amount, not the price. And I do have clients who fall in that category of needing to put that much down in order to qualify for the loan that we're giving them. So important thing to consider. The final point is obviously the type of financing. So there's a lot of misconceptions when it comes to the types of financing and the implications that certain financing have, not only on the qualifications of the borrower and the strength of the borrower, but implications on the transaction success. And I think it's really important to understand these couple things. Number one, government programs for some reason have a lot of misconceptions. And I think it stems from years ago, 10, 15 years ago, these programs had a lot more requirements. They had a lot more difficult processes and procedures to get through. And they could end up making a transaction fall apart. But today, they're much different. There's not really any reason to be concerned about some of these programs. At least if you are, understand what the concerns actually mean. And let me share with you what I mean. FHA, for example. FHA, VA, USDA. Of course, these are all government programs. Government programs have a little bit more particular of an outlook on the property's condition. So because of that, listing agents often perceive them as more difficult types of financing. But it's important to know what these types of programs actually look for in a property, how we can overcome those potential issues in the event your seller accepted an offer with one of those types of financing. Because I'll see it all the time where you'll see a listing, it'll say no FHA buyers. Well, one, you can't really do that, I don't think. But if that's the case, what's the reason? Oh, because there's some peeling paint on the garage. Okay. But if I'm an FHA buyer and I'm okay with painting the garage, does that situation not work for you as the seller? And there's even some situations we can allow you to do these things later, after closing. We can help work with you to come up with a solution to get around these potential issues. Because the government programs are more concerned about peeling paint. They're more concerned about rotting wood on the exterior, rotting trim, rotting deck, windowsills, etc. And they're also concerned about handrails on staircases. Those are really the three main things that we see come up on a government appraisal, VA, FHA, USDA, versus a conventional non-government type appraisal that might not be as concerned about the peeling paint, the rotting wood, or the handrails and the staircases. So if we know those are the three main targets, then all we need to do is quantify the potential risk. Are there handrails on all the staircases? If the answer is yes, then we don't have anything to worry about with an FHA offer. Is there peeling paint on the exterior? If the answer is no, or maybe just a couple windowsills, then we know the potential risk is someone has to paint a few windowsills prior to closing. Doesn't really have to be a professional. We just need paint thrown up on windowsills. The buyer can do that, the buyer's agent, the listing agent, the seller, a friend, uncle, cousin. We don't really care who does it, but that would be something that would have to be done prior to closing if the appraiser points it out, which there are some things that you might see as a concern that the appraiser may not. And that's something important to know as well. Appraisals are subjective. So one issue that you might think will come up may not. So worst case, we just need to know the potential exposure, understand the risk, and come up with a backup plan for in the event those things happen. And I think that's where a lot of people draw the lines, in that they don't understand that there are solutions to some of these challenges. There are ways to get these loans closed, and they don't have to be difficult. And as long as that conversation is had up front about what happens if the appraiser points out the garage has some peeling paint, how are we going to deal with that? Well, come to terms on that now. Maybe the buyer will pay for it. Maybe the buyer will send his uncle. Maybe he's a painter, right? These types of challenges can be overcome. So I wouldn't allow the type of financing to put up roadblocks. You can always talk to your lender, your trusted partner, about what some of the implications are for this specific property. I have listing agents, buyer's agents all the time send me properties and say, hey, can you look at this just to see if you see any concerns with XYZ type of financing on an appraisal or from whatever the case. And I'll look at the pictures and I'll give them my thoughts. There might be nothing of concern in the pictures, and there might be something where it's a question mark. The appraiser might point out X, Y, and Z. They might point out that there's no handrails in the bottom staircase. They might also notice that there is some rotting wood on the exterior trim of the garage that might have to be dealt with. But then again, I can only see the pictures. The appraiser may go there and think differently. So worst case, we might have to address these two things as we go through the process. But now it's clear. We know the potential concerns. So we can start to strategize proactively to see how we can address those. Maybe that can be something where we pivot to a renovation loan. Hey, my buyer really likes this property, but the listing agent said no FHA, and I see these couple things. There's some missing handrails in the staircases, and the exterior has to get painted. What do we have for a solution? Well, either someone paints and installs those handrails during the closing process, buyer, seller, or agents, or third party, or we switch gears. Let's see if we can look at a conventional loan that might not care about those things, or look at a FHA renovation loan. Similar with VA and USDA, we can change products and try to come up with solutions. So don't just assume that everything is black and white in lending. It most certainly is not. So that's the last tip I want to leave for any agents listening to this podcast. Strategize with your mortgage lender. They should be another asset to your team. You should be able to reach out about these types of things and review pre-approvals. I've had agents say, hey, look, I'm on the listing side of things. I got this random pre-approval from this random lender for a potential client. Would you just look at it and give me your thoughts? Sure, happy to. Hey, I noticed in the pre-approval letter they don't reference that the file had automated underwriting findings. I also don't see that that letter includes any terms around verifying. It just talks more like a pre-qualification letter. So I'd call the lender and ask what type of due diligence they did to back up this letter. Did they verify their income? Did they verify their tax returns? Did they get automated approval findings? These types of things are important to understand as you're considering offers. So use your lender as a resource and strategize. And sometimes we come up with things together that might otherwise have been missed. Strategies, structures, ways to get clients into houses and avoid challenges. As always, thank you for listening. If you have questions, you want to talk to me more about this, please reach out and I'll be happy to.